Welcome everyone. And again, thank you for joining in today. Thank you for the tremendous response to this webinar. Today we're going to talk about what the change in administration means to your taxes. And Angie, I've specifically requested Angie to talk from more W-2 and a real estate investor perspective, because that is the relevance for most of us on this call, I would expect. I'm Kavita Barthake. I'm a principal at Cherry Street Investments. I focus on doing mostly syndications, but I'm also a life insurance broker who specializes in infinite banking. Our speaker today is Angie Bhasin. She is a CPA, a CTC, which is a certified tax planner, is a coach and certified a planner.
Coach slash certified
coach tax. Slash, there should have been a CTP there. And she's an MBA as well. And I'll talk about her in detail. She's the founder of FinTax CPAs. And today Angie is here to talk to us about how, what it means to have the change in administration. What are some of Biden's tax policies and how they're going to affect you? We will learn a lot today, so be prepared for a lot of learning. Just a quick disclaimer always, of course, Angie is a CPA, she knows what she's talking about, but this is not a specific advice for your situation. So it's always situational. A lot of this advice is general. So of course, consult your own CPA or set up an appointment with Angie if you have any specific questions as pertains to your situation, right? So this is just an educational webinar, so that's a quick disclaimer there. A few housekeeping rules. Everyone will be on mute because this is a webinar format, except me and Angie. If someone really wants to talk, and actually one of these times I actually promoted Angie to a panelist when there was another speaker because she was answering so many of the questions, which was really how I met Angie. And that was really funny. Angie was actually an attendee on one of my webinars where I had another CPA and actually had to promote Angie to a panelist because she was so darn good. And I'm like, I need that woman on my webinar. So if you have any issues with audio visual at any point, please let us type it in the chat box and let us know so we can fix it. If not, if there are any questions, I ask you to find the Q&A box right now and ask the questions there. It helps for us to track that the questions are answered in Q&A versus it gets lost in the chat box. This webinar will be recorded, and a lot of people send me emails asking if it will be recorded. Yes, it will, and the links will be sent out usually within 20 to 48 hours. I'm kind of procrastinating a little bit because I have a lot of things going on right now. To avoid it from going to spam or promotions, please add my email to your contact list so that you can get it in your inbox. A quick note about, I have an investor group called the Purely Passive Investor Group on Facebook. Feel free to join us. I post a lot of informational content on this. Besides the Facebook investor group, my passion is education. I focus a lot on investor education. I absolutely love doing these webinars. And honestly, if I were to actually grow in my business, I'll probably just focus on webinars. It's all I want to do every single day. So if you want to join me, please subscribe to my YouTube channel. My 2021 focus is on really growing this channel in terms of investor education. I want to do not only will you find these webinar recordings on my YouTube channel, but I'll also be posting a lot of short videos, like 10 minutes, explaining different concepts that a lot of investors ask me about repeatedly. So I kind of want to build a repository of education, like why should I not invest in a single family home? Why should I invest in multifamily or passive investment versus active investments? There's just so many slew of questions which people throw at me. So I kind of want to compile all that into a series of videos, and I'll be posting that on my on this YouTube channel. So please subscribe, help me grow the channel. I'll really, really appreciate that. A little bit about me. A lot of you folks know me, but I see a lot of new faces on the webinar today. So I'm just going to quickly introduce myself. I'm from Bangalore. I moved here to the US in 1998. I have originally a tech background. I got my master's in computer science from Texas A&M. Worked almost 20 years as a technologist in Wipro, IBM, and Atlassian. I have been a real estate investor. Along the way, I started doing real estate investments because I got tired of doing option trading in the stock market. So I got into the real estate industry when it was at the dumps in Austin, even all over the country, really, 2008-9. A lot of you folks who lived through this know how bad it was. It was a great time in retrospect to get started. And I started in single family homes, moved on to multifamily, and now I'm kind of diversified, really, not just single family or multifamily. I've done some senior living and other investments as well, just for myself, and also helping now others focus on how they can diversify their portfolio outside of the stock market, because a lot of people are great in investing in the stock market. Almost everybody has stock market exposure in their portfolios, but very few people have real diversification across multiple asset classes. And that's my goal. I want to educate more people on these investments, on taxes, because taxes are a huge component of making money, right? There's a lot of money people make and give away in taxes, especially you Californians, but there are ways in which you can keep more of the money you earn. And that's really my focus, and not just investing, but also trying to keep more of the money you make. I started Cherry Street Investments as an education first company, focus on how we can impart that knowledge, and these webinars are a part of it. I focus also on passive investments in real estate, and I mentioned another tool which I use very often with my investors is high cash value policies they use for investing into real estate and other things, as well as college savings. I'm a realtor in the Austin area. I do brokerage. I do offer brokerage services. I'm excited. Sorry, Angie, go ahead.
Pretty impressive. Very
thank you. Thank you. You are equally impressive, if not more. I'm excited to have Angie on. Like I mentioned, she was on one of my webinars and she was amazing. So I said, I need to have her on my webinar one time. And we made that happen last year. The recording is on YouTube if you guys want to catch Angie in that webinar. Angie is a certified tax planner and coach and a CPA. She is also the recipient of a prestigious Certified Tax Planner of the Year award for 2020, which is given by the American Institute of Certified Tax Planners, which is amazing. Congratulations on that, Angie.
Thank you.
Angie graduated with a baccalaureate in commerce from India, and also an MBA from U.S. International University in San Diego with the summa cum laude. She is the founder of Fintax CPAs, which is an industry-leading virtual advisory firm. Fintax provides proactive tax planning and customized tax strategies for executives, high net worth individuals all over the country. Angie lives in California with her family, an amazing husband. And actually, I wouldn't be surprised if her husband is on the call today. He was on the last one. And 2 daughters. She is a foodie, and I relate Angie, and she likes to go for long walks and listen to her favorite podcast on taxes, and she is a tax nerd. So, and she owns it. She proudly owns it. That's awesome, Angie. We are excited to have you on. So I'm going to hand it off to you, and I'm going to stop sharing my screen.
Thank you. Thank you so much for that really generous introduction and warm welcome. I'm always really excited to join you in your webinars here. Let me start sharing my screen here. There's a lot of info. This is going to be packed session today. Share screen. Do you see my screen okay?
It's coming on. Yeah, perfect.
Perfect. Well, thank you again. I'm really happy to be here talking about my favorite topic, tax planning. Like I mentioned, this is going to be a pretty packed hour, and it's going to be a lot of information. A lot has happened in terms of tax law changes. So I'm going to try and get through as much as I can. And I just want to share that if I don't get to everybody's questions, I want to invite you all to email me your questions, and I would love to get back to you as soon as I am able to. I promise this is going to be a really good use of your time, and you'll walk away with a lot of info. and tips actually, that can help you put money back in your pocket. My goal is to help you understand how the Internal Revenue Code works and what you need to do to benefit from it, to use it for your advantage. And I like to say you need to stop donating to the IRS, because it really is that with no tax benefit at all. So let's just go right ahead. My contact info is here, and it'll be towards the end as well. Let's talk about taxes. Let's talk about our obligation towards taxes. Even Chief Justice Rehnquist has, he's been quoted to say there's nothing wrong with the strategy to avoid the payment of taxes. That really says it all. The Internal Revenue Code doesn't say that you have to pay the maximum amount of taxes. It just says you have to pay your fair share of taxes. And if this was not important enough already, it has become even more crucial now. As you probably are all aware, the Biden tax law is expected to raise tax rates and take away a lot of the tax incentives that were that came about by the TCJA Act. And as Abraham Lincoln has said, the best way to predict the future is to create it. And this cannot be more true now when it comes to taxes and tax planning. Working with the tax plan and implementing the plan can really be your best investment in the business. Well, think about it. You may want to spend a lot of money in advertising and marketing with the goal to increase revenues, which is a great strategy, but you can't know for sure what your results are going to be. When you're working with the blueprint of a customized tax plan, which is based on your goals, your needs, and you're implementing it correctly, you're guaranteed the savings. And that really is carving out those savings intentionally. We're going to spend a lot of time today talking about planning because that's really the essence of the whole thing. There's going to be changes, but how can we opt out of the Biden tax hike is going to be how effectively we plan for those taxes. I have to, disclaimer, of course, always, this is, as Kavita has shared the disclaimer, this is not legal or tax advice, and it's really for educational purposes. I like to always start by taking a poll here. This is really interesting, and I've never been disappointed by the responses, because when I asked, are you paying in over taxes? Do you think you're paying in over taxes? And if you want to find ways to keep more of your money, the answer is always the same. Yes, overpaying in taxes, and yes, wanting to know how we can manage our taxes and control them. The bad news is that you're not alone if you think that you're overpaying in taxes. Taxes are really for a business owner. And when I say business owner, when you have real estate, you're technically, even if you're a passive investor, you have an entity outside your W-2 realm, right? So and we're going to talk more about those different scenarios too. Your taxes are your single biggest expense. But good news is you can manage your taxes. You can manage your taxes by proactively planning for it. And I'll be using the word proactive a lot today. And that really is the essence of our talk today, that you have to plan ahead and intentionally to be able to reduce your taxes. I'm going to show you ways that you can walk away today with a handful of strategies and implement them in your unique situation to attain your personal goals. How you can improve your cash flow and grow your bottom line and build wealth, build generational wealth. I'll share in some instances how we've saved our clients anywhere from $8,000 a year to sometimes over $100,000 a year. And this all is possible. Obviously, we cannot discuss all the strategies, and because really there's hundreds of strategies and thousands of combinations that can be implemented depending upon each taxpayer's individual situation, but we'll talk about a few today. This is a topic I am very, very passionate about, and this is you'll see through the course of our 1 hour together. There are so many ways that you can reduce your taxes. There's so many options if you are intentionally planning for it. I strongly feel this is where a lot of CPAs, a lot of traditional CPAs, EAs, tax professionals actually fail their clients, because that's just in the traditional model of the CPA firm. Well, I'm not going to go through this. You already, Kavita did a great job, humbled me with the introduction. But just to give you a little bit of my background and how I got to where I am and why I really enjoy what I do. I have been a CPA since 2002. I've been practicing in California. And for a number of years, I've worked just like all other CPAs do, helping my clients with tax filings, consulting. And I truly believed that I was helping my clients with planning to help them save on taxes. And really, that's what all traditional CPAs believe they're doing. All CPA firms, if you know, they will say that they're planning. But I got to tell you this, after, long story short, when I felt that we were not serving our clients, and I felt there was a void in the service that we were providing our clients and what they needed and expected. And I went through extensive training, and I've specialized in tax planning. When I look back, it's like that planning that most traditional CPAs do is so little in comparison to what is really required. You know, at the end of the year, we would say, buy some equipment, give yourself a bonus, all great strategies if you really need to buy equipment, not just to get a deduction. And sadly, that's generally what kind of tax planning, in the name of tax planning, gets doled out. So that's kind of where I come in with, you know, the value that I provide to my clients. Because if you think about it, all the big corporations, Amazon, Apple, they have huge tax departments whose sole job is to research and implement these tax reduction strategies for their clients. It's the small taxpayers, the small business owners, the small investors who don't have access to this. And that's where I am so passionate about bringing this education and then the service to help us as taxpayers regain those tax dollars. You know, the Internal Revenue Code has over 90,000 pages. Last time I did this webinar in early December, it was about 85,000. This recent tax law has added about 6,000 pages to the ever-growing tax code. And a lot of those pages talk about deductions that are available. Deductions that you, as a small taxpayer, as a small business owner, as a small investor, have access to, just like the big ones do. So we're gonna talk about that. And I'm gonna tell you, I'm gonna keep emphasizing how important it is to work with somebody who is forward thinking and a strategist, rather than just a number crunching professional who's taking historical data and dumping it to tax returns. So let us, well, I'm just gonna just dive right ahead because there's so much to talk about. I'm kind of nervous that I have so much to blurt out and I won't have enough time. I really wanna share this, what it means by tax planning and how tax planning works. If you think about it, I like to explain it in terms of red lights and green lights. You know, how the Internal Revenue System works is it's based on codes that really are red lights, which they actually tell you this is how your tax is imposed. You know, you have to stop there at these red lights and pay tax. Could be code section 1, code section 1401, which deals with self-employment tax, or 1411, there's certain code sections that once you get there, you have to pay taxes. But then there are these green lights that are basically deductions. That's like, okay, you go ahead, take a deduction, you go ahead without paying taxes. And these are some of the examples of that. But the bottom line is, most tax professionals are so busy doing taxes that they focus on the red lights. And that's important. Don't get me wrong, because blowing through those red lights is what's going to get you into trouble. And we don't want to do that. But unfortunately, they don't take the time to look for the green lights that help you pay so much less. Looking for the green lights and implementing the strategies to take advantage of those green lights is really what separates tax planning from tax projection. And consider this, sometimes you have to stop at a red light, but then you can take a right on that red light, right? So proactive tax planning involves finding those opportunities in the Internal Revenue Code where most tax professionals will stop, but a tax strategist will help you move in the direction to gain the benefit of that tax code. Now, the tax planning, the green lights that I talked about fall into 4 buckets, which is timing, which could be things like your 401k, which is deferrals. You're not paying taxes now, but you will be paying taxes at a later time. Deals with shifting, income shifting or expense shifting. That could be hiring your children, maybe shifting income from a higher tax bracket into a lower tax bracket. Then there's code-based strategies, utilizing the specific codes, like maybe code section 105, which deals with how you can deduct your family's medical bills as a business expense. Or of course, product-based. There's several insurance and annuities, and sometimes they play a really big role in an overall holistic tax plan. So now that we know what our goal is, which is to exploit the tax code's green lights, let's quickly look at how this process works. It's kind of like going to the doctor, right? If you're sick and you visit the doctor is going to examine you and diagnose the problem. Next, the doctor is going to prescribe you a solution. And then, well, somebody has to fill that prescription, right? And that might mean going to the pharmacy, might mean surgery, or whatever have you. But something needs to happen to fix that issue. And tax planning actually works the same way, if you think about it. The diagnosis is the tax discovery session, whereby we sit down with you, we look over your business and your personal tax returns, gather information from you to determine where you are, what your goals are, what your resources are, maybe what your retirement plans are. And then we diagnose any mistakes and missed opportunities that might be costing you taxes. Now, the prescription takes the form of a tax plan, which is a customized tax plan for you to see what green lights are you missing. And then finally, the tax implementation is the filling of the prescription, right? Which is could be implementation guides, it could be checklists, it could be forms, basically taking that tax plan onto your books so that when the tax return is done, all those deductions kind of flow through. And very important, again, working proactively, you audit proof your returns too, because you're intentionally driving these deductions, which then you're making sure all the proper documentation is in place. So in a nutshell, that's how the tax code works and the tax planning process work. And I wanted to give you this foundation for all the topics that we're going to cover, because it's extremely important to understand why working proactively is going to help you get to your goals without the interference of taxes, right? It just helps you get to your accomplish your financial goals much more efficiently. I don't know if there are any questions, but I'm just going to keep going and then we can kind of take questions in the end. So now let's talk about the tax law changes. There, like I said, there have been so many changes within this last 1 year. There was the Secures Act towards the end of 2019, and then the CARES Act, and then multiple reiterations of the CARES Act, and then of course the Consolidated Appropriations Act that just came into law early this year. Let's talk quickly about a few of the things that are going to be affecting you as individual taxpayers, as business taxpayers, as investors, whether it's real estate, whatever have you. So the big one, I say big, or let's start with the first one, is this $600 per person economic impact payment, which is quite similar to the first round of economic impact payments that most taxpayers got, depending on what your AGI was. There's thresholds there. What this is really, it is an advance on your 2020 taxes. So what's going to happen is this advance, this check that you're getting is being based on your 2019 tax return, which means that if your income fell below or within these ranges, as I have them on the screen, whether you're single, head of household, or married filing joint, on your 2019 tax return, you will get this check. Now, it could be that in 2020, you made more income and you may not be eligible based on your 2020 income. But what the IRS has said is you get to still keep this check. Now, it could also be that your 2019 income was above this threshold and you didn't get any stimulus payment or economic impact payment. But what that means is when you do your 2020 tax return, you will get this credit. So it's not lost if you didn't get it before. Now, a tip to keep in mind is that if you receive this payment, and you will get a documentation from the IRS notifying you got blah 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 amount of the impact payment. Make sure to save that, because that needs to be reconciled on your 2020 tax return. Don't just throw it away. You're going to have to give that to your tax preparer so that they can make that reconciliation of your tax return. And if you got more, you get to keep it. If you got less, then you get to augment that with the remaining. Another change that came about was the change in charitable contributions. So what happened is, with the TCJA Act of 2018, a lot of people didn't need to itemize their deductions on their tax return, which meant was, because of the SALT limitation, property tax and state tax limit got limited to $10,000. So if you didn't have a home, or if you lived in a tax-free state, like some lucky people do, you didn't need to itemize. And so if you made charitable contributions, if you didn't make them high enough, really high enough to be over the standard deduction, you didn't need to itemize. So what this new law has changed is saying that you get an above the line deduction for $300 and $600 if you're married filing joint for 2021 if you don't itemize and if you're just taking standard deduction. But for 2020, it's $300 above the line standard. It's not doubled up for married filing joint. So there's a little bit of benefit over there. The other huge deal, we saw a whole lot of clients take advantage of this in December, because if your income is really high, whether, and we'll talk about what the different options are, whether you're doing a donor advice fund, or you're doing conservation easement, or some other strategies for whereby you're contributing, you're making a charitable contribution. You can, for 2020 and 2021, you can get a deduction of up to 100% of your AGI, which can be huge, which can be in the rights. Again, I always want to say this, it can be huge, it can be really beneficial for the right taxpayer. And then C corporations, cash contributions are generally limited to 10% of the taxable income, but now they have increased that to 25%. So which again is a great benefit. Oh my gosh, this is such a gem. What the Congress has said is that for 2020 and for 2021 and 2022, meals deductions used to be limited to 50%. Well, way back when, before TCJA, there was more liberal, but as a general, it was limited to 50%. So right off the top, if you went to go eat lunch with your client, or your business partner, whatever have you, your meal deduction was limited to 50%. For 2021 and 2022, they have removed that, and it's 100% is deductible. And the reason they're doing, of course, is an attempt to help the restaurant industry, right? But it really helps us too, as business owners, as investors, right? So this is, I think this is a huge gem. This is something that not only is going to stimulate the restaurant industry, but it's also going to help you as a business owner. I would be remiss not to talk about the PPP and the ERC, which, we all heard so much about PPP. And the big thing, I'm trying to touch a lot of topics and not go into too much detail on anything, or on a lot of it. But if you have specific questions, feel free to email me and I'll be happy to get back to you. But a lot has happened, so I want to make sure that you're aware of these big changes. Now, employee retention credit, when CARES Act first came out in early 2020, Congress said that you could either take the PPP loan or you can get what is called the employee retention credit. You cannot do both. But in this Appropriations Act, they have changed that hugely favorable. So now you can take the PPP loan if you qualify, and there's qualifications, and I don't know if it's in my slide over here or no, but if you need more information, I can send that to you. You can take the PPP loan and you can take advantage of the employee retention credit, which is huge, which is up to $10,000 of wages per employee. So not to overlook that. So which can be huge. So now what's happened is there's going to be you're going to have to think a little bit before you apply for your PPP loan forgiveness, because you want to make sure that you don't leave the employee retention credit benefits on the table. So it's not going to be straight up, I used 100% of my PPP funds towards payroll, so I'm just going to apply for forgiveness. So very important to remember that, because you want to play that so that you are able to maximize on both PPP loan forgiveness as well as the employee retention credit. And the employee retention credit, I quickly want to mention, it's 50%, 50% credit for up to $10,000 per year employee for 2020, but that change is really favorable for 2021. For 2021, the first 2 quarters, you're still eligible for taking the employee retention credit, which is up to 70%, and it's $10,000 per quarter. So extremely taxpayer friendly over here.
Hey, Angie,
Yeah.
if someone has a sole proprietor or maybe a husband, wife, or a child or someone as an employee, how does that work with PPP? Do you have to have more than one employee, or are you, if you're paying yourself a W-2 income from your business, is this still something that you can apply for?
So two things over there. If you're a sole proprietor, you do not be paying yourself a W-2. That's a no-no. That's incorrect. But to your second point, yeah, you can have other employees, and that just increases your PPP loans, which takes me back to the second round is out. So we'll talk a little bit about those as well. But in order to get the PPP loan for, say, like you're a sole proprietor, and if you have employees, if you have wages for somebody else, whether it's your spouse or if it's your children, if it's on your 2019 Schedule C, that bumps up your PPP loan that you can apply for. If it's just you, then if it's just you or others, your portion is limited to the net income. It's you take your net income for the whole year, average that, and it's 2.5 months of that. It's 2.5 months for all businesses except restaurants. Restaurants under the Appropriations Act get to take 3.5 months of, are eligible for 3.5 months of PPP. Great question. But yeah, I want to emphasize, when you are a sole proprietor, you don't want to take a W-2 from your business, because your net income is really your W-2, right? Great question. Thanks, Kavita. Again, superly favorable changes, favorable towards the taxpayer. When the CARES Act first came out, Congress intended the PPP loans to be free money. That was their intention. But IRS said, oh no, that's like double dipping. If you get free money, then we're not going to let you deduct these expenses. And they were adamant under IRS Notice 2020-32. They were like, oh no, you can't double dip. You can't get free money and be able to deduct your expenses. But Congress came through in this Appropriations Act, and they overturned IRS. So not only is that free money, it's actually free money because you don't pay taxes on it, and the expenses that are being funded by the PPP loan amount is also deductible, which is great, which is which is tremendous for folks who got the loan. And the other thing it does is for pass-through entities like partnerships and S corps, it increases these PPP loans. They increase your basis. So say you got a PPP loan of 50,000. Your original basis was 50,000. Now you have a basis of 100,000. So if your business kind of had losses or whatever, you're able to then take that loss, flow through to your return. The one catch over here is though the timing difference, because if you haven't been forgiven yet for 2020, and you'll be forgiven in 2021, so that it'll be 2021 when your basis will get increased. So a little bit of timing issue over there, but nonetheless, it's a very helpful benefit. I'm trying to keep an eye on the clock as well. This real quickly, I want to mention this is a new disclosure on 1040, and you'll be required to answer this question for your tax preparer about virtual currency. If you have in possession any virtual currency, and it could be you bought it, you inherited it somehow. If you have possession of virtual currency, it's a disclosure on the tax return that needs to be informed to the IRS. IRS actually sent a bunch of letters reminding taxpayers to report. They're cracking down on this. We got to mention the new Form 1099 NEC. it used to be that for 38 years, actually, non-employee compensation has been reported on Form 1099 miscellaneous. Now there is a new form, 1099 NEC, and that is due on January 31st, versus the 1099 miscellaneous that has a due date of February 28th. And why this happened is because under the PATH Act of 2015, there were changes made to the due date, the 1099 for non-employee compensation. They eliminated the automatic extension of their due date. It only took IRS 5 years to come out with the form, but now we have this form. Who files the 1099? Very important to know. Someone who is not your employee, and it's someone that you are paying, you have paid at least $600 or more in the course of your business. You don't have to issue a 1099 to a vendor or someone who you paid $600 or more to if they're a C Corp or an S Corp, except unless it's for attorney fees. And of course, you need to issue a 1099 NEC if there is any withholding from the payee. I want to mention, I want to show this form actually. So this is the new form. And as you see on box 1, that's where you got to report the non-employee compensation and whatever is here. And if it's subject to self-employment tax, it goes on Schedule C. Now, what's interesting over here is that the instructions for the recipient say that you receive this form instead of W-2 because the payer did not consider you an employee. And look where the IRS is going with this. Did not consider you as an employee and did not withhold income taxes or Social Security or Medicare tax. If you believe as an employee that this is incorrect and that you should have gotten a W-2, you report it on your W-2 and fill out the form 8919. Guess what is happening here? They're cracking down on this. They're cracking down on the W-2 versus independent contractor rules. They're cracking down on the employers who are not abiding by these rules. And Biden actually really supports tightening of these rules because, this is a huge potential for future revenues. And I've had people tell me, well, how does it matter? Taxes still get paid whether you're a W-2 or a 1099, because as a 1099, you're responsible for employee and employer portion of taxes. But think about this. Firstly, when you're a W-2, taxes are withheld on that gross amount. You don't get to deduct expenses that you deduct if you're an independent contractor. The independent contractor, your income gives you a qualified business income deduction, which you don't get for W-2. And you get and timing of the revenue, right? For W-2, you have to withhold taxes at source level when you get a paycheck. But a 1099, you can literally fund a retirement account with everything that you have left and pay no taxes. So they are really cracking down on this. The other big change is now you can file an e-file 1040X, which is the amended tax return. Let's see. Oh, in short form, there's for the self-employed, there's lot of, we talked about the retention credit, employee retention credit, but don't forget the Family First Act and the family leave credit, PPP. There's a bunch of incentives available. And I'm not going to spend time on this, but this is just the 2021 tax rates, which is extremely important right now because with the new Biden tax hike, where he's promoting to tax higher tax rates folks making more than $400,000, it's going to become increasingly important to manage your income low enough so that, try to get, and unfortunately, when you're a W-2 employee, there are very few things. There are still some things, and we'll talk about that, but there are fewer things that you can do to manage your taxable income. But when you're an investor, when you are a business owner, you have the ability to employ more strategies so that you maintain your income below the threshold, so you don't get stuck with the big tax hike. So I'm just going to quickly, if anybody wants, I can just shoot me an email and I'll send these over to you. Note the highest capital gains tax rate is 20%. This is expected to go up to 39% for folks who have income over $1 million. That's a huge, huge increase. And if you have transactions that are going to generate capital gain consequences, talk to your tax planner. Talk to them before you act. Talk to us, because if you talk before you have realized those gains, you have way more options to either defer, you have options to mitigate, and sometimes even eliminate those taxes. It's extremely important to plan for that. We're going to go ahead and quickly talk about, we can't talk too much in depth about the Biden proposal because it's still, it's still up in the air. We don't know that what's going to pass, but the highlight over here is the big one is the tax increase from the top tax bracket from 37% to 39.6% for taxpayers who are making income over 400,000. That's going to be huge. That's going to impact quite a few people. So extremely important to manage, right? The other big thing is the step up in bases. President Biden wants to eliminate that, which is really what that means is when somebody passes, the basis of their ownership in assets increases to the date of death value. They want to eliminate that. And that's actually has caused a lot of people to look into estate tax planning very seriously. And we've worked with a lot of clients towards the end of the year, where we've tried to help them navigate those waters. Something interesting, something favorable is going to be, President Biden has basically said that he's going to do away with TCJA, the Tax Act of Tax Cuts and Jobs Act, which also means the SALT limitation may be repealed, which will definitely be welcomed.
What is SALT? Sorry.
So the SALT is what I referred to earlier, the limitation of state and property taxes. They were limited by TCJA to $10,000 on your Schedule A item.
Got it.
So he's proposing to do away with that.
So basically, people will be able to deduct their property taxes again.
Correct. Yes. Which will be welcome. Yes. Yeah. So some of these other changes, we're not going to go into too much detail. I know I'm right there. President Biden did say that he's going to increase the corp tax rate from 21% to 28%. Just yesterday, we got more insights into it. Of course, this is all up in the air. That may not happen right now because of the current situation of our economy. But that's somewhere in the plan. The plan is, we all know it's going to take a couple of our generations to pay for all this deficit. I really quickly want to talk about some things that you can do to help manage your income, as I mentioned. I talked about capital gains. We hear a lot about 1031 exchange, which is which can be a great tool, but really that's not it. And that may not be the best solution if you have capital gains tax consequences. There are others that may fit better in your situation. Installment agreements, monetized installment sale, opportunity zones, loss harvesting. The bottom line here is that there's hundreds of strategies and thousands of combinations, and there is no one size fit all. So work with somebody who is abreast of all the tax law changes, who specializes in tax strategies, so that you are well served. I cannot emphasize that more. This is my pet peeve. This is the biggest mistake I see, and also the biggest opportunity I see, where people are leaving a lot of money on the table, not being in the optimal entity, whether that's from asset protection side, but more importantly, from our perspective, what we're talking about from a tax savings perspective. So please do not just assume because somebody else started an S corp, that's what you need to do. It must be evaluated based on your own situation and needs. This is, I see folks leaving so much money on the table because of not being able to plan and really utilize the code. Doing it right and documenting it right is crucial, but there are so many ways that you can take tax-free cash out of your business to really help you to get to your financial goals much faster. Unfortunately, I don't have too much time to go over in a lot of detail, but feel free to reach out to me. I mentioned this earlier. The ability to deduct. What proactive tax planning really does is, what we do is we take a look at what your expenses are and then try to see how can we position them in your situation that we can make them tax deductible, right? So in some situations you may have medical expenses, out-of-pocket medical expenses. There are ways that you were able to make that a business deduction in the right situation. Health savings account, again, can be huge. It's really a triple benefit strategy. You get a deduction when you put money in. You let that money grow tax free, and then when you take it out, it's tax free when you take it out for medical expenses, and you can actually let it grow without any interference from taxes, which can be huge. Hiring your children, cannot emphasize enough that this can be really powerful strategy, not only from a financial side perspective, but I like to think of it as teaching my kids the value of money and starting to funding their retirement plan early, so that they have that long spread of years to really grow their retirement account. Oh, I have to tell you, this is such a sweet provision of the tax code, and this is only triggered in the time of emergency that we are right now, which lets you take tax-free money out of your business to pay for personal expenses for you as an employee or for your other employees. There are certain expenses that are deductible, and you'd be surprised, there's a lot that is deductible under the right circumstances. So it's a huge benefit to take advantage, to see if you as an employee, or if your employees are affected by COVID in any way, whether it's they were positive and they had to have testing, so all those testing costs, if they were not covered by insurance, or you had to get your parents to come live with you because of COVID, you have all these extra expenses that you had to incur, tutoring expenses, right, childcare, funeral expenses, and there's a slew of other expenses. Those can be deductible by the business and tax-free to the employee. Very powerful. I know we're at time, but there's so much more that I want to draw your attention to as far as tax strategies. Like I said, the Internal Revenue Code is filled with abilities to take advantage of to reduce your taxes. Don't just take your data into your tax preparer in January, dump it, and then, and they fill out the tax forms with it. Work with a firm that is proactive thinking, is going to help you customize your tax plan based on your needs, help you implement that. What happens is when you're proactively planning, sure, when you do your tax return at the end of the year, you pay less taxes, but you really start seeing that benefit in the next quarterly tax payment if you are a business owner or if you're an investor. Because like for a W-2 employee, you are making, you have withholding, but as a business person, you have to make quarterly tax payments. So when you're reducing your income during that quarter, you pay much less quarterly taxes. So you start to get to see the benefit of it right away. So cost segregation, I can't tell you how important that can be. We've helped a client recently use cost segregation and create an NOL, carry back that NOL. Now you can carry back NOLs for 2020 back up to 5 years and get, I want to say it was like $120 some thousand of quick refunds. It is so powerful. Look at ways how you can increase your qualified business income deduction for pass-throughs, for partnerships, for sole proprietors, for S corporations, because the TCJA Act, as you know, we still have it, gives you the benefit of 20% deduction. How can you manage that so that your deduction is the optimal? Donor advised funds, I talked about, these are more charitable oriented. Conservation easement can be a huge, donor advised fund, conservation easement, fundamental endowment funds, tax bracket management, of course. Those are all, if you're a W-2 employee, those are some of the strategies that you can easily employ. Some of the others, you kind of have to have a business entity or business or a real estate entity involved with it. Pension plan contributions, pension plans, generally what happens is you have to open a pension plan and not fund it. Funding can be done later, but you have to open it by December 31st in order to be able to contribute and get a deduction for that year. For this year, that's not true. So this is a great way for some businesses who have a lot of income, and they still have ways to manage that. So if you're in that situation, please reach out so that we can kind of work with you and see if that makes sense for you. Captive insurance, this is a little complicated, but that's another strategy. Of course, real estate professional status, I think everybody over here knows how important and how crucially beneficial it can be. I don't know why I have a black L over here, but never mind. Creating, and this is the other focus. When we do tax planning, we look at it holistically, not just from taxes, but from your financial goals, from your business planning, whether you're in the growth mode, we help you there. Are you looking to exit? Help you there. Financial planning, what is your retirement nest egg looking like? What should it look like? How do we get there? How do we create different buckets of retirement income so that everything, if you have everything in a 401k, it's all going to be taxed at retirement? How can we create different buckets so that you have some taxed retirement income, some tax-free retirement income? There is so much more. I mean, I could keep on talking taxes, but I do want to, we're over time. I do want to share, I have a really simplified ebook that I can share with you. If you want to download it, go ahead and go to go.fintaxcpas.com, and you'll get a copy of it. It has a few seven strategies that you can actually start employing today, to help you get to your goals. That is what I have. I hope you guys found this helpful, and I invite you to reach out if you have questions. I would love to help. I think that's what my passion is. In fact, I was so touched. One of my colleagues said, we were talking about what is your what was it that we were there was a term, I forget what your superpower is, what your superpower. And she said, your superpower is you really care for your clients. I was like, yes, that's it. I do. Because it's important. Finances play a big part, and if we can just get taxes out of our way, we're so much closer to our goal. And then working holistically, looking at the financial planning aspect, estate planning aspect, just helps relieve, gives you peace of mind. That's all I got.
Thank you so much, Angie. This was very informative. I know it wasn't a lot of depth probably for some people, but what Angie's goal was to give you a high-level overview of all the changes. So obviously it's a challenge distilling 6,000 pages down to half an hour or 40 minutes in presentation time. So thank you, Angie. This was very informative. We will get through some of these questions right now. And if you have further questions that we are not able to get through, I think we can get through the questions we have. But if you have any further questions, feel free to reach out to Angie. You have her contact information. So first question is, how do you reduce taxes on a 150K W-2 for a single person?
I'm sorry, you say, how did you?
I think the question was really like, someone's making 140K in W-2 income, single person. What are the strategies to reduce taxes for someone with just a W-2 and no business?
So just a W-2, you probably, I wonder, do you have a home? Do you own a home? That may be the first place you want to go to, because this is how our economy works. This is how our tax system works. If you have a home, then you have certain deductions. You have interest, mortgage interest, you have property taxes. Do you make charitable contributions? And then going from there, do you have a side gig? Do you have a hobby that maybe you can start venturing into a small business? Do you want to, perhaps you're interested in real estate? You want to, you would be an ideal candidate to benefit from the paper losses from owning a passive real estate, right? Because you're right in that threshold that you're able to deduct those losses. So that might be something you want to consider. Get married.
Get married, yes. There are also some energy investments, I believe, that give you some active income deductions, right?
Yes, yes. And that, absolutely right. But then if you have a little bit of a more, leeway with income, it will make more sense to do that. Yeah, because you have to kind of evaluate, just like with anything else, right? You have to evaluate it. It could be a great strategy for in one case, but does that make sense in your case? Because to get that cost benefit analysis.
Right. Just conservation easements, for example, is a great strategy for someone in a really high bracket, but probably doesn't make sense for someone making 140K. So yeah. And this is why tax planning is very essential, right? It's not like you get to the end of the year and you're filing your taxes the next year, you suddenly think, oh, what could I have done? It's too late to do anything, right? You have to think ahead. Okay, this is a good question. Can you pay your child for some kind of administrative help, say 2K, and issue 1099 for the same?
You can absolutely pay your child for administrative work, provided that they do the work. You want to make sure you got all your I's dotted and T's crossed. There are two schools of thought. You can do 1099 if it's like sporadic. They're not really an employee. They're not working set hours. They're not doing it on a consistent basis. Yeah, you can give them a 1099. And one of the reasons why I also, not only from a tax deduction point of view, but from from the viewpoint of them starting a Roth IRA, say perhaps because they're ideal in that situation, right? They can start funding something which is going to grow over their lifetime. Some financial institutions want to have a W-2. They want to see a W-2 in order to do it. I don't know why some do and some don't, but that may be the only thing that you might run across. But if it's not on a consistent basis, and if they're just couple of weeks in a year they're doing it, or whatever have you, sporadic 1099 is fine. Make sure to issue them a 1099. The only problem with that, of course, is if you issue them a 1099 which is over $600, they're going to have to pick it up as income on Schedule C, and then that gets subject to self-employment taxes and all of that. Versus if you do a W-2 and you have, whatever is that, 12,000 something, the limit.
12,200, yeah, 12,200. So up to 12,200. I don't know if that's changed for 2020.
It's changed this year. Yeah, it changes. I think it's 12,800 maybe this year.
Okay. So you can pay up to 12,800. And I did this for my daughter too. I was able to open a Fidelity Roth IRA and move 6,000 of that. Basically up to 12,200 and 12,800 for 2020 will be tax. If you pay them as a W-2, will be tax exempt, right? I mean, they really don't even have to file a tax return, I believe.
Correct. Yeah. And if you're a sole proprietor, or if you're a partnership, where you are the sole partner, you and your husband are the sole partner, you don't even pay FICA taxes on it. So it can be really, really good.
Yeah, it'll be huge. Yeah, I move it into a Roth, for at least 6,000 of that into a Roth. That'll be useful.
Excellent.
Yeah. So Srini says, any suggested workaround on SALT limits? I think you said they're taking away the limits, or is that?
Well, that's what the plan is. But as of right now, it's still there. There could be, depending if you, I don't know what your situation is, Srini, but if you have a business, shifting income, shifting expenses may work for you. I'd like to know more about your situation to be able to guide you, because on Schedule A of the 1040, it's limited, but can we see other ways how that can be taken, and that's where planning will come into play.
So Lisa says, if you hire vendors to build a website or hire someone to be a virtual assistant, do you have to issue the individuals 1099? These are in US individuals.
Yes, unless they are incorporated, then you don't have to. But if they are sole proprietors and you pay them over $600, you have to.
So let's say you get your AC fixed, you have a rental business, and they have a company, but how do you know if they're incorporated, or do you just do a 1099 for everyone?
When you hire somebody, you must ask for their W-9, which tells you exactly how they are operating.
Okay. So if they are sole proprietors, then you will have to do a 1099 NEC this year.
Correct.
Okay. Can you hire a child less than 12 years via LLC and get a deduction? I think we covered that. Yes, you can. You can do less than 12 years as well, provided they provide some kind of value to your business, I would assume, right?
And the lowest or the youngest in the tax code has been 7 years.
What happens? I know some people will use their children as like a model for their website, and they're even younger than 7. So is that a red flag, or is that perfectly okay to pay them?
Red flag, as long as it's done correctly and it's documented correctly, and they are using them as a model, and they're not paying them $50,000 for something that
modeling
normally pay $500, right?
Yeah, so reasonable.
Income.
Yeah. I have an investment property where I'm paying a high mortgage loan rate as compared to the loan rate for my primary home. I'm considering doing a cash out refi on my primary to pay off my investment home. Is there any negative tax implication from doing this?
What are you going to be using that for? So whether that interest is going to be deductible or no, it's going to be based on tracing rules. So which means, are you going to take out that cash and invest in another real property? That's fine. From that perspective, from deductibility of it, from deductibility interest. Now, if you no, actually, you might be, depending on your taxable income or your AGI, you may even get a benefit. I don't know your situation, because let's say you finance more and then you have higher interest, you'll have a higher, I'm thinking higher net loss from that rental property after depreciation, and depending where your AGI is, you might be able to offset that. Of course, unless if you're above the threshold, and if you're a passive investor, then it's just going to get suspended as passive losses. So don't know too much about your situation to really answer.
Right. But the cash out refi itself is not going to be a taxable event, correct? Because refinance is not a taxable event.
Correct. Yeah.
Only a sale, like when you actually sell your primary home, you'll have to capture that refinance
Right.
cost.
But I think what he's referring, maybe that's what I'm thinking, the indirect consequences of doing that.
You said SALT may be reverted back. What about AMT limit? AMT limit, current AMT limit is at 1 million. Will that be reduced again?
Oh, I hope not.
So no direction on that yet?
Not yet, yeah.
Not yet.
There has been some talk, but no specific direction.
As a single family landlord, if I pay a individual contractor 700, do I need to, I would, she say pay 1099 NEC. I assume she means file a 1099 NEC.
Yeah.
The answer is yes.
Yeah.
Our company's income will be reduced more than 25% this quarter, which is quarter 2021. Whether we will be getting a PPP 2.
You really must evaluate that. So the eligibility requirements for the second draw PPP is that if you have any quarter in 2020, same quarter compared to 2019, if you had more than 25% reduction in gross revenues, you will be eligible for the second round of PPP.
Okay, how do I know if I need to issue a 1099 MIS or 1099 NEC for contractors?
NEC is for any non-employee compensation, any independent contractors you hire. 1099 miscellaneous would be for rent or for royalties, or any other income, one-time income that you may pay.
So, so let's say if I'm getting a repair done on a rental house, it could be an NEC and not a miscellaneous. Is that right? Even though it's like a one-time repair? I mean, I'm not assuming that I'll do it every time. Is that fair?
Yeah, and if you're paying less than $600, you're not issuing anything. But say you are in the business of real estate and you have a contractor that you're working with who did repairs on your investment properties, and you pay them more than $600, and then they're individuals, they're sole proprietors, you have to issue them 1099 NEC.
Okay. So mostly what I think I'm hearing is most of the time when you were doing a 1099 miscellaneous before for these contractors, you'll just do an NEC now.
Correct.
Can I take give a cash gift to my children who are 8 and 6 years old and take tax benefit?
No, sorry. And if you have a business, employ them, put them to work, and then get a tax deduction.
Yeah. At what age can a child file their own individual tax return?
It's not really based on age, it's based on income. So if they have income, if they're making say $30,000 and they're 12 years old, they have to file at 12 years old.
Right. Okay. Last question. What could happen if you don't issue a 1099 but do claim the business expenses? Will there be negative implications?
Yes. So one, it's against the law. So you could be held for penalties on that. And secondly, if you're audited, IRS will disallow those deductions and slap on underpayment penalties and interest, and it's not good.
Not good. So file your 1099s. All right. I think we got all the questions. There was a footnote here which was interesting. Apparently, if you invest in crypto with your retirement account, there is some tax implication. It constitutes a taxable event. So that was an FYI from Amit. Thanks, Amit. I don't know if it's sent to everybody, but I think he sent it to all the panelists. So I'm going to copy that and paste it for all the attendees as well. More of an FYI, I guess. Jas asked, can we get a copy of these slides? I'd like to set up an appointment. Please email me. Angie, you have that. I'll just send this to you as well. There was a crypto question about, okay, what is the question? I'm sorry, I got lost. If you do plan on making purchases with crypto or using it as an alternative to cash, it would be best to hold it outside a retirement account. Amit, could you repeat your question, please? I didn't see a question there. I just saw a note. Okay. I don't see any questions from Amit on that. Not my question. This is my response. Oh, okay. So Amit was answering questions which came up in the chat. Sorry. Let's see. Okay, this is the question. If crypto is held in a EQRPs or self-directed 401k, solo 401k, it does not need to be reported as technically one is not doing a tax return for their self-directed 401k, correct? If I pay my buddy $10,000 in interest for a loan he issued, does it imply that I issue a 1099 to him? Okay, there are two different questions here. So I think the question here is, if crypto is held in a solo 401k account, does it need to be, do you need to do a tax return?
So it has to be reported on it has to be disclosed on the tax return.
So the purchase has to be disclosed, not necessarily that you have to pay taxes on it.
The possession has to, I mean, they're going way out, and no matter whether you purchased it, you inherited it, however, you have to report it.
Got it. Okay. Okay, I think that's it for today. Thank you everyone for joining. And Angie, I just want to say thank you so much. You always come in here and give us so much information.
Thank you. Thank you for having me. You know, I love doing this. And I'm sorry we didn't get into too much detail, but anybody has questions, please.
Yes. Feel free to reach out to Angie. I know it was like a high level overview, but it just gives you some food for thought to go back and research and also plan for the next year, right? That's the most important thing here. If you take away one thing from here, understand that planning is essential. Also, I will be having a webinar on the Roth backdoor. So a lot of people are only trying to avoid paying taxes. Like Angie said, there's only one bucket they think of. How do I not pay taxes right now? But think about the huge deficit that we've created with COVID, all this COVID, assistance that's coming. The money is not coming out of thin air, right? It has to be recovered over the next, I don't know, we'll be paying for this for a long time.
Even though we're minting it, but still, has to be.
You can't just, I mean, there's a lot of effect of printing money, just printing money. So do understand that it's not just important to have one tax-free, bucket that you contribute to your 401k, but look at the other buckets as well, right? And with that note, I'll tell you, we'll talk about the backdoor Roth on how to contribute more towards your Roth. And it might seem like, oh, I don't want to pay taxes right now, but trust me, you'd probably want to pay taxes the way we're going to be headed. So take advantage of that.
Timing of it, right? Especially if this is the year when you maybe didn't make as much as you usually do, and you might be
Especially,
making more next year. This would be the year to do it. Well,
yep. Someone asked, what's the best way to contact Angie? Angie, could you want to throw up your information again, just so